let's look on the metrics of a company that's going to help you make decisions as to what you want to invest in. We're going to look at some ratios in here that are really critical in a lot of different aspects. So the metrics overall, they're quantitative measures as the company's performance and their financial health. You want to pay attention to that because you don't want to get a company that is unhealthy, so to speak, financially and in severe structural problems. Although maybe you do, because of the fact the higher the risk, the better the results. If the company pulls out of it, the stock's going to skyrocket. So it depends what you're looking at. We use these a lot by the investors, the analysts, the creditors, and so on to really see how the company is doing overall. The metrics, they can see if you have an undervalued or overvalued stock. By the way, these are the tools that Warren Buffett uses to make his multi-billions of dollars that he has and his company to be famous for the world's highest stock price. So you want to compare different companies within the same industry. That way you can sit down and see which one has the best benchmark overall for the different aspects of the investment that you're looking at, because it's going to pay attention to you that this is the best one. Well, this one may not be as valuable as this one over here, but its stock is only 1/3 the cost and it's about 80%. I'm going to buy this stock over here. Actually, those things are happening, and that's what you're looking for. You're looking for the most undervalued stock that you think is going to become more valuable over time, and that'll help you make the best decisions. It's going to help you track their performance over time, identify areas of improvement. If they get a new CEO, they get a new finance officer to do this, then they'll have that. So you pay attention to that and then watch the company sometimes. Sometimes you watch a company for a year even to see if changes are there, and you have it on the list that you have going on. And so maybe it'll make better decisions about the market, or maybe the market's changing that's out there. So what probably the most used metric out there is called EPS, earnings per share. And this is not rocket science. How much is it earning and how many shares are out there? That we can see how much each individual share is worth. Now, by the way, this is going to be different for every single company. You're going to have a hospital chain that's going to be very different from a car industry, because the car industry, you have a lot more capital input, and a hospital, you have a lot more individual input. So you don't have as much money, except then you start getting expensive machinery in the hospital. You have something like that. Compare that to let's say you buy a fast food chain. You'll have a different metric in each one, especially including about EPS. So pay attention to what's going on in the industry as well. And then the PE ratio is probably the second one out there. So the PE ratio is a price earnings ratio. And you want to look at that. It helps the valuation ratio of the company's stock price to the share that's out there. So these two ratios are probably the most used out there. You can find all the information like this and almost any kind of really website that's out there. Robinhood's big, Yahoo Finance, Morningstar, Bloomberg, Reuters. Okay, so you have Reuters, you have that going on. The Wall Street Journal publishes them on a daily basis. So it depends what you're getting into. If you're going to start buying stock, pay attention to all the companies that put these metrics out there. Then you have the price to book ratio. It's not used as much as the other two, but you really need to know, especially if you're doing the serious analysis as to what you plan on buying. Is the valuation ratio to compare the company's stock price to its book value per share. If there's a discrepancy, all of a sudden you start paying attention to what's going on, and then I would even pay more attention big picture wise. You want to look at all three of these ratios. They're all in proper alignment. And if they're not, then start paying attention, because you may have an opportunity to get an undervalued company or maybe an overvalued company out there. You also have a thing called the DDM, the dividend discount model. It really is, we look at this to see really how much dividends is paying, because some companies don't pay any dividends at all. It just depends what you're looking for. And it's based on the assumption the value of the stock is equal to the sum of all its future dividends. It depends what you're looking at. Some growth stocks don't pay dividends at all. They have all retained earnings. So it depends what you're looking for. And sometimes you can count the retained earnings in this model over here. But looking at the intrinsic value of the stock equals the sum of all future dividends divided by the discount rate. It's not that hard to figure out what it is. So look at what that is as well. It's not used as often. It depends what you're looking for. So to use the metrics, the metrics plus others that you may want to use, the PE ratio really compared to valuations of different companies within the same industry. It really is handy. If you want to use the DDM, that really is the intrinsic value as to whether it's overvalued or undervalued. So pay attention to all four of these metrics. They're probably the most widely used. Some additional tips: Cross-reference information from multiple sources. Pay attention to the currency and timeliness of the data. Old data is old, and that's why we call it old. Okay, and sometimes you can see a historical pathway, but it doesn't always mean that it's relevant to today. And then consider the tools out there in the software, interpret those metrics in the context of that company's industry as to what's going on. And then to close, the metrics are tools for investors and analysts, but it's important to note that financial metrics should not be used in isolation. Sometimes common sense kicks in, even if the metrics are speaking this language over here. Sometimes there's an instinctual thing of, I see this happening over here. The whole market is, you may have a gut instinct, and sometimes your gut instincts are correct. It just depends. So investors should also consider other factors. You have the management team, you have a competitive landscape. This player just went belly up over here. So maybe that'll change it. So you pay attention to what's happening out there. Sometimes you look at the environment the company is in and see what the changes are happening, because the company may rise all of a sudden or fall all of a sudden, depend upon the competitive environment or the financial environment of the overall economic environment. So pay attention on the investments over there. A lot of times in this game of investment, you have a winner and you have a loser, and someday you may be on the loser end if you're not paying attention to what's going on, especially if the metrics are out of balance and you're investing in the company that you love too much and not paying attention to what's going on from the financial perspective. With that, pay attention to the metrics, track these particular ratios. It'll help you an awful lot big picture, but it doesn't mean no matter what happens, you may have all the ratios in perfect sequence and things still go wrong, because this is called the market. That's what it's like. Take care.